Hello, this is Leroy Meadows, and I want to welcome you to this session. In this session, in part two, we're going to pick up where we left off for decision making and relevant information. So now we're going to focus on capacity, and then we'll also deal with a number of other decisions. But capacity, let's start out with capacity. Product mix decisions are decisions managers have to make about which products to sell and in what quantities. So if we have a constraint, such as a limited amount of machine hours, we want to choose the product that produces the highest amount of contribution margin per unit of the constraining resource, not the highest contribution margin per unit of the product. And here is why. Let's get out of this. And let's go back to our book here. And where's my... Oh, there's this one here. Okay, so let's take a look here at our capacity per day. Our capacity per day is 300 units. Let's see, is this the right one? Okay, this is the right one here. Okay, so let's go ahead here and look at contribution margin per unit and why we should not do it. Selling price for the snowmobile engine and the boat engine, and that is for the company Power Recreation. They make two different types of engines: snowmobile engines and boat engines. Snowmobile engines sell for $800. Boat engines sell for $1,000. We take the variable cost per unit that are relevant in the situation, $560 for snowmobile engines, which leaves us a contribution margin of $240 per unit. And that gives us a contribution margin ratio or contribution margin percentage of 30%. Let's take a look at boat engines. We sell those for $1,000 per boat, per engine. Variable cost per unit is $625. So we have $375 per engine of contribution margin, which gives us a 37.5% contribution margin percentage. Now, let's say we're limited by the number of machine hours that we can use. We have a bottleneck. We can't change anything. We have machine hour limits. Now, if we take machine hours in consideration, let's take a look. It takes 2 machine hours to make a snowmobile engine and 5 machine hours to make a boat engine. So how much does it cost per machine hour to make? Well, it only costs $120 per machine hour to make for snowmobile engines, but it takes $75 a machine hour to make a boat engine. So if we look at contribution margin for 600 machine hours, we're looking at $72,000 per versus boat engines of $45,000. So we want to look at contribution margin per machine hour. And actually I said cost. That's not cost, it's contribution margin per machine hour. The one with the highest contribution margin per machine hour is the one we want to focus on. Snowmobile engines, $120 per machine hour of contribution margin. $75 contribution margin per machine hour if we make boat engines. So for every snowmobile engine I'm making, I'm contributing $120 per machine hour. My total contribution margin, if we're limited to machine hours, is $600. If I make just nothing but snowmobile engines, my contribution margin total is $72,000. My total contribution margin for making boat engines is $45,000 if I only make boat engines. So if I have a choice to either make snowmobile engines or make boat engines, I'm going to favor the snowmobile engines. Why? Because my total contribution margin for that $600 is going to be higher for making snowmobile engines than it will be for making boat engines. So that is the focus of where we want to be when we're looking at highest contribution margin per unit of the constraining resources, not the highest contribution margin per unit of the product. Because, and let's go back to our example here, if we just look at contribution margin percentage per unit, we would favor the boat engine because it has the highest contribution margin percentage. However, when we get into the nitty-gritty of the numbers themselves and take into account the constraining resources, we see that our total contribution margin, considering that limited constraint of machine hours, is actually higher in total when we make the snowmobile engines, and that actually had the lowest contribution margin percentage based on units. But when we take into account the constraining resource, which in this case was machine hours, then we see that we should be favoring making snowmobile engines. So we don't want to get into the trap of just looking at contribution margin per unit. We want to delve deeper and figure out what is the highest contribution margin per unit of the constraining resource. And in that case, it was machine hours. Now, when we talk about constraints, we also have to include the concept of bottleneck. And a bottleneck is simply any part of the company that restricts output, restricts outflow. So by increasing the width, and we take a bottle, and your book uses the illustration there from the assets of water metaphor. You can have different bottles. The rate of outflow, or the rate that water comes out of the bottle, is constrained by how big that neck is of the bottle. If I take a 20-ounce bottle and fill it up with water, and I start to pour it out, I can only pour out as much as that the neck of the bottle will allow me to do. But let's say I take a pitcher of water that has a wide open top, and I just fill it up. Well, as I pour it out, I can pour it out a lot faster. Why? Because there's less constraint on and less restriction on the rate of outflow. So that's what we mean by bottleneck. What is constraining? What is restricting the output of units within a company? If I have, let's say Department A, Department B, and Department C. Department A can put out 200 units per shift. Department B can put out 225 units per shift. And Department C can put out, let's say, 190 units per shift. What would I consider my bottleneck operation at this point? My bottleneck operation is going to be the operation which constricts it to the lowest amount of output. So my bottleneck in this situation would be Department C. Why? Because that's where I have the tightest restriction on output. I can output the fewest number of units in a shift. So that is my bottleneck. That is my constraint. So I have to try to figure a way to relieve that bottleneck point. I have to try to figure a way to increase capacity there, because the most I can output at any one time is the least amount I can put out at any given point in the production process. So here I can only put out, in any given day, I can only output 190 units per shift on any given day. Why? Because I can make more and open up capacity here, but will that additional capacity either in Department A or Department B, will that matter? No, because at the end of the day, Department C can still only produce and output 190 units. So my daily limit is going to be 190 units, because that's the least amount I can get out, or that's the department with the least amount of output I can get in any given shift. So when we talk about bottlenecks, we're talking about the restraining factor, and this is my bottleneck point. So And this is where capacity of an entire system is limited by a single or limited number of components or resources. So whatever my bottleneck here is, it's holding up everything else. So what is actually happening? I have product from Department B. As I transfer them to Department C, if B is running at full capacity and I'm constantly pushing things through, I'm going to have a buildup of inventory right here. And then Department B is going to have to shut down because it's going to have too much inventory. So what do I have then? I have idle time. If I slow down production for any reason, I'm going to have people standing around. I'm going to have machines not being used to their potential. So I'm going to have idle capacity. I'm going to have a cost of the idle capacity, as we talked about in Chapter 9. For capacity not used, I'm going to have that cost of capacity not used, and I'm going to have that assigned to B. And then subsequently Department A too, because even Department A, even though Department B can take as much as they want, at some point, if Department B has to shut down, then eventually Department A will have to shut down because Department C can't keep up with anything. So Department C is going to be my bottleneck point. Now, the theory of constraints will describe methods to maximize operating income when we're faced with some bottleneck and non-bottleneck operations. And the theory of constraints define these three measures as you see in the book. Throughput margin is simply the cost of is simply revenues minus the direct materials cost of goods sold. Investments equals the sum of direct materials costs in raw materials inventory, in work in process inventory, and finished goods inventory. So direct materials, wherever they are in the production process, whether they haven't been pulled to production floor, whether they are in work in process, or whether they're in finished goods inventory, the total amount of direct materials inside the plant are considered, plus research and development costs, plus capital costs of equipment and buildings. So that is in what we term investments under the theory of constraints. And then operating costs are the cost of all operations other than direct materials to earn throughput margin. And that would be such as salaries, wages, rent, utilities, depreciation, and so forth in the production process. So now, the object of the theory of constraints is to increase throughput margin while decreasing investments and operating costs. We want to increase the amount of product that can go through while decreasing investments and keeping those as low as we can. Now, let's take a look at how to manage bottlenecks. First of all, we need to recognize the bottleneck operations, and we have to recognize that the bottlenecks themselves determine the contribution margin of the entire system. Going back to our example that I just illustrated on the screen, bottleneck operation was in C, so that's going to limit the contribution margin of the entire system, because no matter how many units A makes, which is 200, B makes 225 units per shift, and C can only do 190. So the most we're going to get for total contribution margin for the entire system is 190 units per shift. So second of all, we need to identify the bottleneck operations. And in our case, we did. We identified Department C as the bottleneck operations. 3, keep the bottleneck operation busy. We always want to keep them busy and subordinate all non-bottleneck operations to bottleneck operations. So everybody else's schedule is going to be worked around the bottleneck operation. So in our illustration with Department A, could put out 200 units. Department B could put out 225 units. Department C can put out 190 units. Everybody else's schedule is going to be focused on working around Department C and keeping them running all the time. And we can take actions to increase the efficiency and capacity of the bottleneck operation, which is in Department C. How can we do that? Well, we can make sure that we minimize downtime by maybe having people come in, shifts come in, and instead of shutting down machinery per shift, so the next shift comes in, maybe just make that transition so the new shift walks in and just immediately takes over without any downtime, so we can have a little more output. Maybe we can increase the bottleneck operations by maybe converting another machine, if another machine is able to be converted to do the exact same thing as Department C. And let's say Department B may have a machine or an equipment that can do the processes in Department B as well as in Department C. Maybe converting that machine at times and switching it back and forth and doing setups for that activity and converting it to something that Department C needs. If we can add another machine that we can convert over to using to do what Department C does, then we now have increased capacity on a temporary basis to relieve the bottleneck. So, and sometimes companies will have assets that can be converted from one type of operation to another. And if we can do that, then we can allow Department C to increase its capacity in the short term. Ultimately, though, we're going to have to increase capacity in the long term if we want to increase our total contribution margin for the company. So we're going to have to in the short term, there may be some things we can do, but really capacity is going to be a long-term decision. So let's talk about now customer profitability and relevant costs. When we take into account customer profitability, the cost object is our customer, not a particular product or service. So we have to ask, does adding or dropping a customer add operating income to the firm? If it's yes, then we add or don't drop. If it's no, then we drop the customer or don't add the new customer. And the decision is going to be based on incremental income of the customer, not how much revenue a customer generates. So let's take a look here at this and go back to the example in the book here. Let's see here. And let's go to this analysis here. This is the next one here. Here we go. We see that a customer profitability for the company, and what's going to be an issue here is not Vogel, not the customer, Brenner, because each one of them produces positive operating income. The issue is with the customer Whisk. Why? Because that customer has negative operating income due to various factors. We'll take a look at that. And the total overall company for the Whisk company, or for Allied West company, is $7,000 operating loss. Now, if I'm just looking at numbers here and don't do any further analysis, I am going to assume that if I drop Whisk right off the bat, then I'm going to have an operating income of $9,000 from Vogel plus Brenner, $16,000, give me a $25,000 additional operating income. I'm going to make that assumption if I just look at this and say, okay, I'm just going to drop Whisk. However, I need to go further into seeing, in my decision-making process, I need to see what's relevant and irrelevant. So when I do that, I'm going to take into account the lost income. If I drop Whisk, I'm going to lose $400,000 of revenue right off the bat. I'm going to have cost savings of cost of goods sold, $330,000. Furniture handling labor, or the labor for moving the Whisk account in the facilities, by $33,000. I am not going to have any furniture written off as depreciation because I'm going to have that furniture handling equipment regardless of whether I still have the equipment. I'm not losing the equipment. I'm not selling the equipment. I still have the equipment because that equipment has been allocated to Whisk. It's not going to have to be absorbed by the other customers. And in this situation here with Allied West, they're allocating some of these costs based on how much of the warehouse that customer takes up. So that is a valid way to do that. If I have a warehouse and the products for one customer takes up half of the warehouse, and the products for two other customers take up the other half of the warehouse, 1/4 each, then my warehouse is full. The customers who orders take up half the warehouse fairly should support half of the overhead associated with that, and then the customers that take up each a quarter of the warehouse should assume 1/4 of the cost of the overhead for different things. So that is how they're handling some of these. So this allocation, the warehouse rent. Well, the warehouse rent that the Allied West incurs is going to be the same. The warehouse is not going to be cheaper to rent just because we're not using part of it. It's kind of like the concept of renting an apartment. If you rent an apartment, you're renting it for the whole month. Does the landlord give you a break because you only use it for 20 days and you're gone for 10 days and you don't use it for 10 days? No, you don't get that break. You're going to pay the rent for that month in the apartment, regardless of how much you use or don't use the apartment. Same here with the warehouse rent. The company is not going to save any money because it's still going to have to pay rent on the whole facility, not based on how much of it is used. So the company is not going to save any money on rent. Marketing support, the company will save $10,000 in cost because it's no longer having to market to the Whisk account. Sales order and processing deliveries and processing of deliveries, we're going to save $12,000. So our total cost is going to be $385,000 we're going to save. So what happens here? I'm giving up $400,000 of revenue, but I'm only going to save $385,000 of cost. So if I drop Whisk, then what's going to happen is I'm going to lose an additional $15,000 of operating income. Because why? Because some of those costs are not going to be lost just because we dropped Whisk. Furniture handling equipment written off as depreciation, rent, administrative, corporate office costs. The Whisk account is just assuming some of those costs on a proportional basis. Those costs are still going to be incurred. What's going to happen now, though, is the other customers are going to have to absorb those costs. So here, we should not drop Whisk because if we do, we're going to lose $15,000 of additional operating income. Then let's see if we add revenue just on adding another account. If we do, and they're assuming the assumption is the same, that it's going to be pretty close to adding the cost and everything are going to be, if we drop the adding the L'Oreal account and drop everything and drop the Whisk account, what's going to happen here? We're going to get a $6,000 increase in operating costs. So are we really gaining by losing losing the Whisk account? No, because we're going to lose operating income. But what if I keep Whisk and add the L'Oreal account? Then I'm going to increase operating income. So again, that focuses on figuring out which costs are relevant, which ones are irrelevant. So, and that's what we need to do in the decision-making process when adding or dropping customers. So now, go back here, and we do the profitability analysis. Now, some other things we do have to ask is when a customer doesn't produce positive operating income, why? Are they ordering all low-margin products? Are there high sales order costs? Are there high delivery processing and other costs? High marketing costs? So once we identify these, we can work with the customer to reduce these costs by maybe getting them to place bigger orders, maybe higher margin products to reduce some of those costs so the customer themselves become profitable. Now, in the customer profitability analysis, we have to take at least one distinction between relevant costs of adding versus dropping a customer. Depreciation cost is going to be irrelevant. Why? Because that equipment has already been purchased, but the purchase of new equipment in the future is going to be relevant. So previous equipment purchases we made, irrelevant, and the depreciation associated with that. But if we have to purchase new equipment, then that cost will be relevant if we're going to add a new customer. So we want to make sure that depreciation costs on past and previous purchasing decisions are sunk costs, as we talked about before, and then but any cost of any purchasing any new equipment is going to be relative. Now, in the same vein, sometimes companies have to decide whether between closing the stores, branch offices, business divisions, or even adding offices and divisions or stores, locations. If you see a store such as Best Buy or even your local chain convenience store, they're going to do a profitability analysis to see, should we order or should we open a new store? Should we close a store? So with this, a lot of times we have to take a look here, and often branches, divisions are allocated a share of corporate costs. So if corporate costs are going to be incurred is going to be the same, then those costs are not irrelevant. What is going to happen is if we shut down something, we're going to shift the allocation of those costs to the ones that remain open. So those costs may not change. In the irrelevance of past costs and equipment replacement costs, remember the cost, accumulated depreciation, book value of existing equipment is not relevant. Potential gains and losses on the transaction is not relevant. Why? Because it's financial accounting, and the only reason we incorporate that is on the books is to report gains and losses for tax purposes and for financial accounting purposes, for GAAP purposes. Now, costs that may be irrelevant, or may be relevant rather, in the decision-making process for equipment replacing decisions. Costs that may be relevant is the current disposal value of the old machine. So let's say in my Trailblazer, I have a Trailblazer. It's an old piece of garbage, but it's still there. If I'm going to and let's say it breaks down and I have a decision to make. If I'm going to either repair my Trailblazer or replace it with something else, are original cost of my Trailblazer going to be relevant? No. Any accumulated depreciation with it? No. Any gain or loss on it? Any book gain or loss on it? No. But if I choose between the alternative of repair or replace, the disposal value is going to become relevant, because I do not get a disposal value under alternative A of repairing, but under alternative B of replacing my Trailblazer. Then I'll have my salvage value, my trade-in value, as well as the cost of a new vehicle if I trade in my Trailblazer for something else. Again, that cost of a new vehicle would be irrelevant, or would be relevant. Why? Because I incur that cost if I'm going to replace my Trailblazer. I do not incur that cost if I am not going to replace my Trailblazer. And this is a decision I'm going to be making in the future I have not already made. So now, despite the quantitative nature of aspects, not all managers are going to choose what's in the best interest of the firm. Some managers, as we've talked about a number of times before in previous chapters, will consider how the company will judge his or her performance after the decision is implemented. So managers may consider unethical to take actions to make their own performance look good when these actions are not in the best interest of the firm. And I would agree that it is unethical to take actions to make my own performance look good instead of doing what's in the best interest of the company. Not all managers subscribe to that ethical level of conduct and will do what's in their best interest and what makes them look good versus what makes the company look good. So so managers that have that will need to be dealt with or be judged a little bit more differently based on not what makes them look good, but how do they help the company achieve their goals and objectives. And the decision model can dictate what one decision, but in the real world, would managers want to follow it? And this is an extension of that, because how do we use the decision model, but then we're also having a performance evaluation? Now, in theory, resolving that difficulty seems we should have a model The decision-making model and the performance evaluation model should be consistent. However, in the real world, they are often not consistent. So we have to find a way for subordinate managers to make decisions that are in the best interest of the company through the performance evaluation, so that their goals are now going to align with company goals and we have goal congruence. So that should be our focus. As far as managers, a lot of times it's an really easy decision to make. For some managers, hey, we're going to do what's in the best interest of the company. For other managers, they're going to take, hey, you know what? This bonus, if I get it, is going to be what, $10, $15, $25,000. Do I really want to give that up? Do I want my performance, evaluation to look weaker, and then possibly make me at risk of losing my job? So you're going to have competing theories here. Some people are going to align their goals with that of the company. Some people will align their own personal goals against the company. So that concludes this session. And I want to thank you for joining us in the decision making and relevant information chapter here. We do have some examples that are posted up for exercises and so forth. So you may make sure you watch those as we make decisions. So I want to thank you for joining us today. Have a good day.